Welcome back to the Deep Dive, the show where we cut through the noise and get straight to the core of what you need to know. Today, we're plunging into a topic that most people, well, when they think of financial markets, they probably overlook it entirely. When you imagine a successful trader, what immediately springs to mind? Is it someone glued to like a multi-screen setup, eyes darting across complex charts and flashing numbers, maybe shouting orders? Most of us default to thinking it's purely about algorithms, cold, hard market data, lightning fast execution. But what if success or failure in trading hinges on something far more personal, something internal and often completely unseen? What if the most powerful trading tool you possess is actually your own mind, or maybe your biggest obstacle? Today, we're embarking on a deep dive into the critical, often unseen forces at play in financial markets, trading psychology. Get ready for some genuinely surprising facts and maybe some aha moments that will absolutely shift your perspective on what it means to truly trade well. It's really time to start coaching yourself from the inside out.
That's a really crucial distinction, and you've hit on the very essence of today's deep dive. While knowledge, and experience, sharp analytical skills, they're undoubtedly foundational in trading, no question. But the emotional and mental components are equally, if not, sometimes even more significant in determining a trader's consistent performance and their long-term success. It's not just about understanding the intricate dance of the market. It's also understanding your own internal reactions within that whole dynamic. In this deep dive, it's grounded in some really insightful materials, specifically from an Investopedia article. It's called Trading Psychology: Definition, Examples, Importance in Investing. It provides an excellent, pretty practical framework for understanding these often hidden dynamics.
Okay, so our mission today is clear then, and it feels deeply personal for anyone listening who trades or even just invests. We're going to uncover and understand these hidden psychological influences, these biases that shape trading decisions and, well, by extension, market outcomes too. And most importantly, we're going to explore how you can identify them, how you can overcome them, how you can maybe coach yourself, right, to make more informed, more rational, and ultimately, hopefully, more successful choices in your own trading journey. It's about empowering you really to master your mental game, turning those potential pitfalls into, well, pathways for profit. So let's unpack this. We're talking about trading psychology. Sounds kind of broad, maybe a bit academic, but the Investopedia source gives a remarkably clear, concise definition. What exactly is that at its core?
Right. At its core, trading psychology, as the article defines it, it refers to the emotions and mental states that help dictate success or failure in trading securities. Simple as that, but profound. It's not just some soft skill or, a secondary consideration you can afford to sideline, not at all. It truly represents the various aspects of an individual's character and behaviors that fundamentally influence their trading actions, day in, day out. And the Investopedia article powerfully emphasizes this point. It says it can be as important as other attributes, such as knowledge, experience, and skill in determining trading success. Think about that for just a second. It's placed right up there, on par with your technical analysis skills, your deep understanding of company financials, maybe years you've spent watching market cycles. It's that foundational. And two of the most critical aspects they highlight in the source material: discipline and risk-taking. Just imagine a really volatile market day, huge swings, maybe news breaking. Without solid discipline, your perfectly crafted trading plan, it can just fall apart under pressure, easily. Similarly, an inability to objectively assess and take appropriate risks. Or, the flip side, an excessive willingness to take on way too much risk that can quickly erode your capital. So a trader's consistent and rational implementation of these two aspects, discipline and risk assessment, regardless of what the market's doing outside or how they're feeling inside, that's absolutely vital. Vital for the sustained success of their trading plan. Without that solid psychological foundation, even the most brilliant analytical strategies and those sophisticated algorithms, they can completely crumble when they face real-world market pressure. It's your inner game, really, that determines if you can actually execute your outer strategy.
Okay, this is where it gets really fascinating for me because when we talk about trading psychology, two primal emotions almost always seem to come up immediately: fear and greed. They feel like these twin engines of market irrationality, right? Constantly battling it out inside every single trader and sometimes influencing entire market cycles.
Oh, indeed. They're the classic emotional catalysts, aren't they? Often leading to those big boom and bust cycles we see. Let's dive into greed first because it's just so powerful. The source defines it as an excessive desire for wealth, so extreme that it sometimes clouds rationality and judgment. Notice that key word there, excessive.
Hmm.
It's not just about wanting to make money, that's normal. It's when that desire becomes so overwhelming, so intense, that it actually distorts your perception of reality,
Yeah.
makes you abandon logic and the behaviors it leads to. Exactly what you'd expect when someone's judgment is clouded by this intense desire. We see concrete examples like making really high-risk trades without doing adequate research first, maybe taking on a position size that's way too big for your capital.
Right, betting the farm, basically.
Exactly. Or buying shares of some untested company, maybe a new tech stock, just because its price is rising rapidly. That's classic FOMO, fear of missing out. But it's fundamentally fueled by greed.
Yeah.
The greed to capture those quick, seemingly easy gains. This often means buying without doing any real fundamental research at all, completely ignoring the underlying value or lack thereof. Furthermore, greed can inspire traders to stay in profitable trades much, much longer than is probably wise, trying to squeeze out every last penny of profit. This often leads to giving back significant gains when the market inevitably turns.
Oh, yeah, I've seen that happen. You're up big, feel invincible, then suddenly, poof.
Exactly. Imagine you've had a great run with a stock. It's up, say, 20%. But you think, oh, it could go to 30%. And then it pulls back hard, and your 20% gain shrinks to 5%, maybe even turns into a loss, all because greed stopped you from taking profits when your plan said to. It can also lead to taking on these large, overly speculative positions, totally disproportionate to your actual risk tolerance, because you believe you found the sure thing. The article points out that greed is most apparent, most widespread in the final phase of bull markets when speculation runs rampant. Makes sense. That's when everyone wants to get rich quick, right? When prices are just soaring and caution goes out the window. Precisely, ignoring all the warning signs.
And then the flip side of that powerful coin, fear. If greed is about holding on too long or chasing too hard, fear must be about what, letting go too soon, or maybe not even getting in.
It's exactly right. Fear has the inverse effect, and it can be equally destructive, really. It, quote, causes traders to close out positions prematurely or to refrain from taking on risk because of concern about significant losses. So while greed might make you chase the market higher and higher, fear can make you bail out at the absolute worst possible moment, selling at the bottom. This emotion becomes particularly palpable, you can almost feel it, during bear markets or sharp corrections. And here fear can quickly morph into panic, leading to significant sell-offs from panic selling.
Yeah, you see that cascade effect sometimes.
You do. You see a small dip, maybe just a few percentage points, and suddenly fear just grips you. Your logical brain sort of shuts down, and you're just scrambling to get out to preserve whatever capital you have left, even if it means locking in a loss that might have recovered. And this individual panic, multiplied across thousands of traders, can contribute to those broader market declines. It creates a kind of self-fulfilling prophecy of selling. It's a powerful primal instinct to protect yourself. But in trading, it often leads to decisions that really harm your financial health in the long run.
But it's not just those two big ones, fear and greed. The source introduces a third, and I think this one is often overlooked, an emotion that can truly derail a trader's discipline: regret. It's that horrible, gnawing feeling of what if, or if only I had.
Absolutely.
Yeah.
Regret is subtle, but it can be really insidious. The source says it may cause a trader to get into a trade after initially missing out on it because the stock moved too fast. Think about it. You watched a stock, maybe you even considered buying it at a lower price, but you hesitated. You weren't sure. Now it's soared, maybe doubled, and you see others online celebrating their gains. That feeling of missing out, that sharp pang of regret, pushes you to jump in now.
Yeah, chasing it after the move has already happened.
Exactly. You buy when the price is already elevated, perhaps near its peak, just to avoid feeling that regret again if it goes even higher. The source highlights how this is a clear violation of trading discipline, because you're not following your predefined strategy, your rules. You're reacting emotionally to a past missed opportunity. And unfortunately, it often results in direct losses, as the security price frequently pulls back from those peak highs right after you finally decided to chase it. It's such a powerful lesson in sticking to your plan, isn't it? Not letting past decisions or non-decisions dictate future irrational ones. You really have to coach yourself to forgive those past misses and focus purely on new, valid opportunities based on your current criteria.
Okay, so if we pull all of this together, the basic definition, the huge impact of greed, fear, and now regret, what does this all mean for your portfolio performance? For the listeners, bottom line, it's not just about feeling bad or good, right? These feelings have real, tangible impacts on your money.
Precisely. The direct link is absolutely undeniable, and yet it's often overlooked or underestimated. A trader's portfolio performance is directly tied to the investment decisions they make. Simple enough. But those decisions are, in turn, profoundly affected by the trader's emotions, their subjective inclinations, their gut feelings, and their unique mental processes, their wiring. It's a closed loop that many people just don't fully appreciate until it's too late. Even when a trader uses rigorous analytical methods, okay, whether it's deep fundamental analysis, diligently poring over financial statements, economic conditions, company management,
or technical analysis, looking at charts and patterns.
even then, psychological factors can still interfere. They can sabotage the best analysis. The source clearly states that biases, which are the subjective prejudices we all have, and heuristics, which are like unconscious mental shortcuts and patterns our brain uses. Both of these can distort how an individual collects and interprets that very data they're analyzing.
So the data itself might be objective, but our reading of it isn't.
That's a great way to put it. This isn't about being unintelligent or lazy. It's just about being human. Our brains are wired for survival, for quick decisions, for shortcuts, and those don't always translate well to the objective, probabilistic demands of financial markets. These distortions inevitably impact decision-making, and the result is errors in judgment, potentially leading to suboptimal portfolio performance. This really explains why the psychological component isn't just important, it's often the crucial differentiator, the thing that separates consistent success from persistent struggle for a trader. It highlights the absolute necessity of coaching yourself, of becoming acutely aware of these internal forces, because believe me, they're constantly at play, whether you recognize them or not.
Now, what's truly fascinating here, and you touched on this, is that there's a whole academic field now dedicated to understanding why we humans make these often irrational financial decisions. It's called behavioral finance, and it's been a genuine game changer, hasn't it? Challenging some really long-held beliefs about markets.
Oh, it truly has. It's revolutionized our understanding in many ways. Behavioral finance is defined as a subfield of behavioral economics that identifies psychological influences and biases that affect the financial behaviors of traders and financial practitioners. You see, for a very long time, traditional economic theory, particularly the famous efficient market hypothesis, or EMH.
Right, the idea that markets are perfectly rational and prices reflect all information instantly.
Exactly. That theory operated on the strong assumption that market participants were entirely rational actors, always logical, always objective. The idea was that everyone processed all available information logically, made decisions purely based on objective data, and therefore prices always reflected true, fundamental value. But behavioral finance came along and presented a significant, really paradigm-shifting challenge to that core assumption. It acknowledged that market participants may be prone to biases and heuristics, which impact rational decision-making. It basically said, hang on, humans aren't robots. We're predictably irrational.
Predictably irrational, I like that.
Yeah, captures it well. And this field has been instrumental in helping to explain all types of market anomalies, including steep rises or falls in securities prices that the old, purely rational models just couldn't account for. Think about the sudden, seemingly inexplicable market bubbles or crashes that don't seem to align with any fundamental news release. Behavioral finance offers a compelling explanation rooted in human psychology. It's about finally bringing psychology into the economic equation, recognizing that financial markets are driven by people, and people are complex and not perfectly rational actors.
And this field, behavioral finance, it isn't just abstract theory locked away in universities. It has actually identified specific categories of biases that you might encounter as a trader. It's not just a general feeling of being irrational. There are distinct patterns to it, right? Let's break those down because I think understanding the categories is probably the first step in recognizing them in yourself.
Absolutely. Understanding these categories is foundational for any kind of self-coaching or self-correction in trading. Generally speaking, traders face two main types of behavioral biases, and they each have slightly different origins and manifestations. First, we have what are called cognitive biases. These are described in the source as patterns of errors or blind spots in thinking that are common to human beings, which result from subconscious mental processes. Quote, so imagine your brain taking a mental shortcut, maybe to save time or energy, and that shortcut, while maybe efficient for everyday life, leads to a systematic error in judgment when you apply it to complex financial decisions.
Like a faulty bit of wiring in our thinking process.
Yeah, that's a good analogy. They are essentially systematic errors in thinking that affect the decisions and judgments people make. The source gives examples like overconfidence bias, mental accounting and anchoring bias, among other examples. These are often about how we process information, or more accurately, how we sometimes misprocess it, leading to logical inconsistencies or misinterpretations of the facts. Second, distinct from those, there are emotional biases. Now, these are different. They're defined as deviations from rationality arising from feelings, moods, perceptions, or beliefs. So unlike cognitive biases, which are more about flaws in our thinking processes, emotional biases stem directly from our gut feelings, our current mood, maybe our deeply held beliefs about money or risk.
So this is less about faulty logic and more about being swayed by how we feel.
Precisely. Examples given include herding behavior, loss aversion bias, and the emotional impacts of fear and greed, among others. We've already touched on fear and greed, and it's really important to understand that both categories of biases, whether they're rooted in our thinking patterns or they bubble up from our emotional states, can result in irrational judgments and errors in decision-making. They are both powerful forces that can push you way off course from your carefully planned trading strategy, regardless of how intelligent or experienced you might be. Recognizing if your potential error stems from a faulty thought process, a cognitive bias, or from a powerful feeling, an emotional bias, that's really key to figuring out how to address it effectively.
Okay, let's zoom in then on some of these specific biases. Because hearing the definitions is one thing, but seeing how they play out, I bet they're incredibly common, often appearing without us even realizing it. You might find yourself nodding along as we describe these, maybe recognizing some in your own past decisions, perhaps. It's like holding up a mirror to your own trading history sometimes, revealing patterns you didn't consciously acknowledge before.
Indeed. Understanding the specific manifestations of these biases is absolutely the key. It's how you recognize them in your own behavior and then begin that process of coaching yourself out of them, or at least managing them. Let's start with one called mental accounting. This refers to the propensity of persons to treat different sums of money differently by allocating it into mental categories or buckets, rather than treating all money as interchangeable.
Right, like found money versus earned money.
Exactly. It sounds so simple, doesn't it? Money's money. A dollar's a dollar. But psychologically, it's just not that straightforward for us. You might treat money you get from a tax refund very differently than money from your regular paycheck, or a bonus from work differently from money you've painstakingly saved from your salary over months. The classic example in investing, this comes directly from our source, is the tendency of investors to sell winning stock positions over losing stock positions when they need to raise some cash.
Why is that irrational, though? Isn't locking in a profit good?
It can be, but the reason matters. Often, the source points out, selling the loser may be the more rational decision due to tax loss benefits and the potential that the losing investment may be the weaker investment. Fundamentally, you might be holding onto a losing position, maybe a stock in a declining industry, just hoping it will come back to break even. And you sell a winner, maybe a strong company with great prospects, just to lock in a small profit.
So you're selling your flowers and watering your weeds, basically.
That's a perfect way to put it. And this decision is often driven purely by this mental categorization of winners as different to losers and a distaste for loss-taking. It's an emotional attachment to the feeling of winning and an avoidance of the pain of realizing a loss, even when it's financially illogical or detrimental to your overall portfolio health or your tax situation. The coaching takeaway here is to view all your capital equally, regardless of its source or its current performance status, winner or loser. Make decisions based purely on future prospects and your overall strategy, not on the past cost basis or how you mentally bucketed the money.
That's a huge one. Gosh, it's incredibly difficult to cut your losses sometimes, isn't it? It feels like admitting defeat, even if it's clearly the smartest move going forward. Okay, next up, a common trap for, well, maybe anyone who feels they finally got a handle on things, overconfidence. This one feels particularly sneaky.
It is sneaky, largely because it often masquerades as competence or skill. Overconfidence is defined simply as the tendency to overestimate one's own abilities, skills, and knowledge. It's human nature, isn't it? To think fairly highly of ourselves, to believe we're maybe a bit above average in things we care about. But in trading, this bias can be particularly damaging. While many investors genuinely believe themselves to be more skilled or smarter than other market participants, the source bluntly notes, it is, however, statistically impossible for most investors to be above average. Lake Wobegon effect, right?
Right, everyone can't be above average.
Exactly. Yet the vast majority tend to believe they are, especially after a few lucky wins, perhaps. The negative consequences are clear and often financially painful. Overconfident investors have the tendency to trade excessively, resulting in higher transaction costs and poor performance. More trading often just means more fees, more commissions, more slippage, and frankly, more opportunities to make mistakes.
The churn and burn effect on your account.
Precisely. They might also take on larger positions than their risk management plan actually allows. Or they might ignore diversification because they believe their individual stock picks are somehow infallible. Why diversify when I know this one's a winner? And studies back this up. They show that overconfident investors consistently overestimate their own predictive abilities and the precision of the data given. They think they know more than they do, and this results in emotionally charged behavior and excessive risk-taking. They take bigger bets because they believe they have an edge they don't actually possess, leading to positions that are way too large for their actual skill level, making them highly vulnerable when the market inevitably moves against them. It's a direct challenge to that idea of really knowing yourself, knowing your true capabilities and your limitations.
And then there's herd behavior, which feels almost instinctual for us as social creatures. It's that deep-seated urge to follow the crowd, right? To not be the odd one out, especially when everyone around us seems to be making money hand over fist.
It is deeply ingrained, absolutely. It's likely a remnant of our social evolution, where sticking with the group, doing what others did, often literally meant survival. Herd behavior states that people tend to mimic the financial behaviors of the majority of the herd. Pretty straightforward. And this stems directly from the natural human desire to feel like a part of the crowd. Safety in numbers, maybe. When everyone around you seems to be buying a certain stock, maybe a cryptocurrency or some hot sector, and they're talking about their quick gains, maybe on social media or at parties, there's a powerful psychological pull to join them. You feel like you're missing out.
You don't want to be the fool who sat on the sidelines.
Exactly. The profound pitfall here, though, is that investors may follow these investment actions without doing their own research and assuming that others have done research. They think, well, if everyone else is doing it, it must be right. Surely someone smart has done the due diligence. This lack of following, this outsourcing of judgment, is notorious in the stock market. It's seen as a primary cause behind dramatic rallies and sell-offs. It fuels bubbles, where price is completely detached from any underlying fundamental value, and it absolutely exacerbates crashes as panic selling takes hold and everyone rushes for the exit at the same time. The source gives a classic and still painful example for many, the dot-com bubble of the late 1990s. Investors, following the crowd, purchased securities in many internet-based businesses in anticipation of future profits which never materialized, resulting in a sharp sell-off. Remember pets.com.
Oh, vividly. Billions wiped out.
Exactly. They didn't do their own due diligence on business models or profitability. They just followed the perceived wisdom or perhaps the frenzied irrationality of the masses. It's such a stark reminder that consensus, especially in markets, doesn't always equal correctness. Sometimes the crowd is just plain wrong.
Then we have what the source calls the emotional gap. This sounds like those moments where your emotions just completely take over, just override any logic or plan you might have had.
That's exactly what it is. The emotional gap refers to decision-making based on extreme emotions or emotional strains, such as anxiety, anger, fear, or excitement. It's that moment when rational thought completely exits the building, gets kicked out, and raw feeling takes the wheel. The core message here is that emotions are often a key reason why people make irrational choices. It seems obvious, but we forget it in the moment. We circle back again to fear and greed here, as they are highlighted as notable drivers leading to massive overreactions. These overreactions can give rise to unfounded optimism, irrational exuberance, and asset bubbles like we just talked about. Or conversely, they can lead to market panic and major sell-offs.
So it's the extremes fueled by emotion.
Yes. Think of the almost euphoric frenzy you see sometimes at the absolute top of a market bubble, where all caution is just thrown to the wind, everyone's a genius. Or think of the profound despair and hopelessness during a market crash, where traders are just dumping everything at any price just to get out. These are periods driven entirely by the emotional gap, where any rational assessment of value or risk is just thrown out the window in favor of raw, overwhelming feeling. It's not just about experiencing an emotion, which is normal. It's about acting on it impulsively, letting it create this huge chasm between your thoughtful, prepared strategy and your impulsive in-the-moment actions. Coaching yourself here means recognizing when you feel that intense emotion welling up, recognizing you're in that gap, and deliberately pausing, stepping back before acting.
Another powerful one, and I think many people will recognize this from their own experience, maybe even with things like house prices, is anchoring. It's about getting stuck on a past number,
Right.
a reference point, even if it's totally irrelevant now.
Yes, anchoring is incredibly common and can be really difficult to overcome because it feels so intuitive. It refers to attaching a financial decision to an arbitrary reference point in trading. In trading, the most common and often damaging example, which the source highlights, is investors using their purchase price of a security as a reference point or anchor for their decision-making.
Yeah, I bought it at $100, so it must be worth $100.
Exactly. That's the thinking. The pitfall is immense. They, quote, may therefore hold investments which have lost value because they have anchored their estimate of fair value to their original purchase price. So you bought that stock at $100, it falls to $50, maybe even $30. But you hold on to it, refusing to sell, because deep down in your mind, its true value is still anchored at $100. You cling to the hope, often desperately, that the stock will somehow return to what you paid for it, even without regard to its future prospects or outlook. The market has moved on. The company's fundamentals might have drastically changed for the worse. Maybe its competitors are eating its lunch, but your mind is still anchored to that initial entry price. And that anchor prevents you from making a logical, forward-looking decision about the investment's current value or its future potential.
It sounds related to the sunk cost fallacy, too.
Very much so. You're emotionally invested in your initial decision, in being right about that purchase price, rather than objectively assessing the present situation and the probabilities going forward. This is such a crucial area for self-coaching. Learning to detach from sunk costs, detach from that anchor price, and focus purely on where the investment is likely headed now, not where it's been or what you paid.
And then there's self-attribution, which sounds a bit like a defense mechanism, maybe? A way we protect our ego when things go wrong, or maybe inflate it when things go right?
It absolutely functions like that, and it's particularly insidious because it actively inhibits learning from mistakes, which is critical for any trader's growth. Self-attribution refers to a tendency to regard successes as resulting from their own personal abilities, while regarding failures to be the cause of external factors. My genius? Your bad luck. This usually stems from maybe an intrinsic knack or perceived talent in a particular area, or sometimes just a simple desire to feel competent and smart. Within this bias, individuals tend to rank their knowledge higher than others, even when it objectively falls short. Back to overconfidence in a way.
So if a trade works out.
If a trade works out, the investor attributes successful investment performance to their own superior decision-making skills. They pat themselves on the back, maybe they tell everyone how they called it perfectly, believing they outsmarted the market or saw something others missed. I knew it.
And if it doesn't work out?
Well then, they attribute poor performance, not to poor decision-making, but to bad luck, or unforeseen external market conditions they couldn't possibly control. A sudden geopolitical event, a black swan, maybe blaming the Fed, or manipulated markets, anything but their own analysis or execution. This bias prevents genuine learning from mistakes because you never really take ownership of the error. If it wasn't your fault, there's nothing to learn, right? It perpetuates this skewed self-perception of one's trading abilities, hindering growth, and making you susceptible to repeating the exact same mistakes over and over again. True coaching, real improvement, involves brutally honest self-assessment after every trade, win or lose, taking ownership of both successes and failures and analyzing the process, not just the outcome.
Okay, finally, let's talk about loss aversion. I think almost everyone listening can relate to this one on a gut level. It's that visceral feeling where losing money just hurts more, often significantly more, than gaining the same amount feels good.
Absolutely. It's one of the most fundamental findings in behavioral finance, actually. Loss aversion is defined as a common psychological error that occurs when investors place more weight on the concern for losses than the pleasure from market gains. The source states it simply and profoundly. Losses prompt more emotional reactions within investors than the impact of an equivalent amount of gains. It's asymmetrical. This means if you lose, say, $100, the pain, the negative feeling you experience, is often far greater, maybe twice as great psychologically, as the joy or pleasure you'd feel from gaining $100.
So avoiding that pain becomes a huge motivator.
A huge motivator. This disproportionate emotional response means traders are far more likely to prioritize avoiding losses over making investment gains. Their focus shifts from seeking gains to preventing pain. As a result, this bias can lead people to wanting a higher payout to compensate for losses. They might take on excessive, potentially unrealistic risks trying to make back a loss quickly because the pain of that loss is so great. This is often called revenge trading.
What?
Or, and this is perhaps even more common, it can lead to trying to avoid losses altogether even if the investment's risk is acceptable from a rational standpoint.
Like being too conservative.
Exactly. It might mean missing out on perfectly good, well-researched trading opportunities because the perceived risk of any loss, however small and manageable, just feels too psychologically painful to bear. Or, linking back to mental accounting and anchoring, it can lead to holding on to those losing positions for far, far too long, just hoping they break even, purely to avoid the acute pain of realizing that loss on their statement. It's a core challenge for absolutely any trader, beginner, or pro. It requires conscious effort, real discipline, and a strong mental framework to overcome this deeply ingrained human tendency to fear loss more than we value gain.
Wow, okay. That's quite a list of biases and emotional traps. So if you don't pay attention to these psychological factors, these biases we've just detailed, if you just let them run unchecked in your trading, what are the real-world consequences you might face? What are the most common and damaging pitfalls that people fall into?
Oh, the pitfalls are numerous, unfortunately, and they can be quite damaging, not just to your portfolio P&L, but also to your confidence, your whole mindset as a trader. The Investopedia article does a good job outlining several common pitfalls of traders neglecting trading psychology, and just recognizing them is a huge first step in avoiding them. For instance, a classic pitfall we keep coming back to is finding yourself selling winning investments quickly while holding on to losing investments for too long in hopes of recovering to the purchase price.
Cutting winners, riding losers.
Precisely. We just discussed this with mental accounting and loss aversion. You're so quick to lock in small profits because you fear giving them back, avoiding that potential pain. But you cling desperately to the losers, maybe averaging down irrationally, hoping they'll magically turn around, rather than cutting them decisively and reallocating that precious capital more efficiently to better opportunities. It's a direct assault on that old trading maxim. Let your winners run, cut your losers short. This bias makes you do the exact opposite. Another really common pitfall is following the crowd and chasing recent top-performing assets, ignoring the need for due diligence and disregarding data on future prospects.
Straight up herd behavior again.
Pure herd behavior, fueled by FOMO. The excitement of seeing an asset skyrocket, driven by other people's reported gains, and that intense fear of missing out, completely overrides your own critical research and any rational assessment of its long-term viability or current valuation. You end up simply buying high because everyone else seems to be doing it without really understanding why you're buying, or if the underlying value even remotely supports the current price. This often leads, predictably, to buying near market tops and suffering significant losses when the trend inevitably reverses. We also see traders acting impulsively on information received based on their perceived superior investing abilities. This speaks directly back to overconfidence and that self-attribution bias we discussed. Believing you're smarter or maybe have better instincts or access to special information than others can lead to making these really snap decisions without thorough analysis, often escalating your risk unnecessarily.
Like acting on a hot tip without checking it out.
Exactly. You might hear a tip from a friend or see something on social media, feel an immediate rush of certainty, and just pile into a position without doing any of your own homework or checking if it fits your plan, convinced you're ahead of the curve this time. Furthermore, a really significant pitfall is trading excessively while underestimating investment risk and failing to adequately diversify investments. This links back to overconfidence again. An overconfident trader might believe they can predict market movements so accurately that they don't really need diversification. Why own 10 stocks when I know this one is going up?
Right, putting all the eggs in one basket.
Yes, exactly. Leading to highly concentrated positions and also much higher transaction costs because they're constantly jumping in and out, churning their account, often unprofitably. They might take on completely disproportionate risk in a single asset, convinced it's a sure thing, leaving their entire portfolio incredibly vulnerable to a single bad outcome. And finally, and perhaps the most visible pitfall because it happens during dramatic market moves, is impulsive decision-making during periods of market volatility due to fear or greed. When markets are swinging wildly up or down, that emotional gap we talked about widens dramatically. And traders who lack psychological discipline, who haven't coached themselves, they make irrational buys near the peaks fueled by greed. It's going to the moon. Or they make panic sells right at the troughs driven by overwhelming fear. Get me out!
Buying high and selling low, the classic mistake.
It's the classic, and it's almost always driven by these emotions. These are typically the absolute worst possible times to act on impulse, and they inevitably lead to the most severe and often portfolio-crippling losses. So the overall message here is really clear. Understanding the concepts of trading psychology can assist in making more informed and rational decisions. It's fundamentally about empowering you to sidestep these incredibly costly mistakes and navigate the markets with much greater composure, discipline, and ultimately, effectiveness.
That's the key, isn't it? Understanding the problems is absolutely crucial. We spent a lot of time on that. But the really good news here is that you are absolutely not powerless against these biases. It's not hopeless. The source outlines clear, actionable strategies to overcome these pitfalls and significantly improve your trading game. It really is about actively coaching yourself, isn't it? Building up your mental resilience and discipline over time. It's exactly right. This isn't just about identifying the problems and feeling bad about them. It's about providing concrete, actionable solutions that empower you, the listener, to take control. The Investopedia article details 3 core strategies for traders to overcome biases and significantly improve their decision-making. These are practical steps anyone can take. The first strategy is improving education of behavioral finance principles. Now, this isn't just about reading academic papers. It's about using this knowledge as a practical self-coaching tool. By enhancing your self-awareness, by understanding how your mind is wired to create these biases, knowing their names, how they typically manifest in trading, and why they're so tempting to fall for you, can enhance self-awareness and improve decision-making.
So knowing is half the battle.
It really is. It's about knowing the enemy, so to speak. And in this context, the enemy can often be yourself, or rather your brain's default settings, those shortcuts. Just recognizing a bias as it's happening, maybe feeling that pull of regret urging you to chase a stock, or feeling that surge of overconfidence after a win, that recognition is a critical first step to counteracting it. It allows you to pause, to question your immediate impulse, and crucially, to refer back to your rational, predefined plan. This education helps you anticipate your own psychological weaknesses before they manifest as costly mistakes in your account. The second strategy, and this is perhaps the most powerful one in practice, is developing and sticking to a trading plan with trading rules and risk management practices.
Having a roadmap, essentially.
Exactly. A detailed roadmap. This provides a structured approach to investing. And crucially, the source notes, it minimizes room for emotional decision-making. Think of your trading plan as your personal guardrail, okay? Your mental anchor against those emotional storms we talked about. A well-defined plan isn't just a vague idea like buy low, sell high. No, it includes clear, objective criteria for when to enter a trade, when to exit, both for profit and for loss. Predetermined position sizing rules, how much capital you allocate to each trade based on risk, and strict risk limits, like your maximum acceptable loss per trade or per day or per week.
Takes the guesswork and emotion out of it, hopefully.
That's the goal. This plan forces you, or should force you, to make decisions based on predetermined logic and objective criteria that you set when you are calm and rational, not based on the impulsive urges of fear or greed that inevitably arise in the heat of the moment when money is on the line. When you have a plan and you've committed to following it, you're much less likely to react emotionally to a sudden market swing or a burst of exciting news. You look at the market action, then you look at your plan, and you execute according to the plan, period. It's a commitment you make to your rational self, kind of a pre-commitment strategy that shields you from your own emotional volatility. This plan is really your ultimate coaching document, the thing you hold yourself accountable to. And the third crucial strategy highlighted is performing objective research and seeking diverse data. This sounds basic, but the nuance is important. It means you absolutely must do their own objective, fundamental, or technical analysis research on investment opportunities. Don't just rely on tips or headlines.
Do your own homework.
Do your own homework, yes. But it's not just about doing some research. The source really stresses the importance of seeking a range of data to support the analysis, including contrarian perspectives.
Contrarian perspectives. So, looking for reasons you might be wrong.
Precisely. Why is this so vital? Because it assists in avoiding herd-following behavior and challenge existing beliefs. It fights confirmation bias. This means actively seeking out information, opinions, and data that might contradict your initial hypothesis or challenge what everyone else seems to be saying. If you're feeling incredibly bullish on a stock, consciously seek out bearish analyst reports. Look for the red flags, the potential weaknesses, the counter-arguments. Why might this not work out? If you believe a market is due for a crash, make yourself read and try to understand the arguments for its resilience, for why it might continue higher. It's about rigorously looking at both the bull case and the bear case for any investment or trade, and critically evaluating all sides before you commit capital. This intellectual rigor helps you make decisions based on a much more complete and objective picture, rather than succumbing to groupthink or that dangerous confirmation bias, where you only seek out information that confirms what you already want to believe. These 3 strategies, education, planning, and objective, diverse research, when you diligently apply them, they can truly transform your trading outcomes. They help move you from being an emotional reactor to becoming a disciplined, thoughtful, and hopefully more successful operator in the markets.
Wow. Okay, so today we really took a deep dive into the fascinating and, let's be honest, often challenging world of trading psychology. What we've learned, I think, is that your mental state, your emotions, your inherent biases that we all have, they're truly as important, maybe sometimes more important than any technical chart, any financial statement, or any market news report in determining your trading success.
Yeah.
It's like this silent internal force that can make or break even the most brilliant analytical mind. Ignoring it really is like trying to drive a race car with a flat tire, isn't it? You're just not going to get very far, or you'll crash.
And it's a force that absolutely cannot be ignored. Not if you're seeking consistent long-term success in this field. It will catch up to you. We've reiterated again and again, based on the source, that understanding these biases, these heuristics, and the incredibly powerful influence of emotions like fear and greed, these are not just abstract academic concepts. They are fundamental, practical insights that can profoundly assist in improving decision-making and trading outcomes. It's about tangible results. Applying critical thinking to your own internal processes, examining your own mental traps and emotional triggers is just as vital, if not more so, than any external market analysis you perform. It really is about becoming your own coach in the high-stakes, incredibly demanding game of trading. Recognizing your human vulnerabilities, your psychological weak spots, and then actively building strategies and habits to manage and overcome them.
So, what does this all mean for your journey as a trader, for everyone listening? I think it means empowerment. It means recognizing that you actually have far more control than you might think. Not control over the unpredictable market, because nobody has that, but control over yourself, over your reactions, over your decision-making process. The market will always be volatile. It will always throw curveballs. But your approach to it, your internal response, doesn't have to be volatile too. So here's a final thought to leave you with. As you continue your trading journey, maybe starting tomorrow morning, how will you actively challenge your own assumptions? How will you challenge your emotional responses when they flare up? How will you consciously work to turn these profound psychological insights we discussed today into tangible, consistent success in your own trading practice? Will you commit fully to developing and, more importantly, sticking to that detailed trading plan? Will you proactively seek out those contrarian views, the ones that challenge your comfortable beliefs, even when they're uncomfortable to read? Remember, the path to mastering the market often begins and ultimately ends with mastering the mind.